Hello and welcome back from the summer break to a new edition of Amundi's Market View. My name is Victoria Pateman, Marketing Manager at Amundi, and I'm here today with Monica Defend, Head of the Amundi Investment Institute. Welcome, Monica.
Thank you, Victoria.
So, Monica, could you begin by giving us a rundown of key events shaping markets over the summer?
Yeah, sure. This summer has seen pivotal changes that have clarified the policy uncertainty prevalent earlier in the year. July and August saw not only the US budget bill being passed, but also a number of key trade deals, notably with Europe and Japan. The postponement of tariffs on China has also mitigated initial worries about a rapid escalation of the trade war between the two superpowers. On the corporate side, then, a better than expected earnings season has reinforced the equity rally, especially in US big tech, with the S&P 500 index reaching new all-time highs in August.
You mentioned new tariff agreements. How have these impacted your growth expectations?
Well, tariffs are just slightly above our initial expectations, with ongoing exceptions in some sectors, so the overall macroeconomic outlook hasn't changed much. As tariffs effectively raise taxes on consumption, we continue to expect the United States economy to experience a soft patch in the second half of 2025. Consumption and real income growth are bet to slow, although not permanently. In Europe, as tariffs take full effect and net trade becomes a drag, we expect growth to remain weak. But private consumption should progressively normalize and investment should pick up gradually, supported by further monetary easing from the ECB and potential fiscal policy expansion.
What about the impact of these new tariffs on inflation and central bank policy?
Powell's remarks at Jackson Hole acknowledged that tariff effects on inflation are starting to be visible. With that said, the Fed appears more focused on growth risks than on inflation, emphasizing that longer-run inflation expectations remain anchored and policy is still restrictive. Beyond September, we expect a gradual shift toward a greater accommodation as the economy weakens further. Changes in senior Fed personnel could also shift the balance toward more easing. So far in Europe, disinflation has continued at different paces. We expect this trend to persist due to lower energy and commodity prices, euro appreciation, and tariffs-related disinflationary pressures.
And what about emerging markets? Could you give us your macroeconomic outlook for those?
Emerging markets' growth in the second half of the year is expected to moderate, with several emerging markets already implementing supportive fiscal measures. India has launched a reform to reduce goods and services tax, while Brazil proposed a contingency plan to extend credit to sectors affected by tariffs.
So has the current geopolitical climate had much effect on emerging markets?
The last few months revealed an accelerated transition towards a multipolar world. Middle powers have increasingly started hedging their geopolitical relationships as the United States wakes up to its dependence on China. India has leverage in this regard as it represents an alternative to China. While the US-India relation is currently frosty, there are avenues for things to improve as Modi will be in the US later this year, and the United States has no interest in pushing other powers closer to China.
And given this economic backdrop, what are your main investment convictions?
Firstly, larger fiscal deficits and near-term risks to inflation expectations are pushing long-term US yields up. Despite that, monetary easing remains on the cards due to weak employment numbers and political pressure. In fixed income, then, a dovish Fed and contained emerging market inflation could be positive factors for emerging market corporate and hard currency debt. Corporate spreads in the United States and in Europe are at expensive levels. After the recent spread tightening, we are slightly less constructive than before on EU investment-grade spreads. Nonetheless, In our view, the asset class continues to offer attractive income prospects, and we say positive from a medium-term perspective. Equities. The S&P 500 is now even more concentrated than it was at the start of the year, and valuations are once again at their highest. Hence, we favor opportunities beyond the mega-cap names in the United States and in Europe and Japan that offer more appealing valuation. The tariff-related impact on Europe could be partially offset by reforms to enhance fiscal and monetary policy, competitiveness at the European Union level long-term, and declining energy costs. Lastly, we maintain our constructive view on gold due to the continued fiscal excessiveness from developed market governments and geopolitical and inflation risks. Overall, I would say the summer did not have an extreme impact on fundamentals. We maintain a mildly pro-risk stance confirmed amid a rotation towards emerging markets.
Monica, thank you very much for sharing your views with us today.
My great pleasure.
And thank you all for tuning in. I hope you've enjoyed this special edition, and we'll see you next month for another market review.